I get the emails too. The promise of stock market riches through high dividend yielding stocks. Like it's some kind of easy button. Just track down the stocks, with the highest dividend yields, and voila, instant profits. Indeed, I get the attraction of these stocks offering yields of 10%, 15% and more. But these investments are often traps, often seeing the future dividends slashed or enduring severe price drops, or both. This is just one of the 3 common myths income investors cling to, often to their great financial detriment. I'm not trying to scare you, just a friendly wake-up call that there is a better way to go with dividend stocks, one that leads to ample income while at the same time producing impressive share price gains. This is a better, safer road to market outperformance. The first step in our journey today is to just dispel all the 3 common myths that haunt dividend investors. After proving the fallacy of these approaches, I will light a way to a smoother path. That includes a focus on the 10 most important metrics that point to the healthiest dividend stocks. In fact, by the end of the video, I will show you how to get access to the top 7 income stocks to buy now. They come from a proprietary model that has generated an average gain of 24.96% per year all the way back to 2003. And yes, it is outperforming the market once again this year. By the way, my name is Steve Reitmeister. If that name rings a bell, it is probably from the nearly 20 years I spent leading Zacks.com, one of the most respected investment websites. My commentary has been read by millions of investors, helping them chart a course to better results. I'm proud to bring all my years of experience to Wall Street Zen, where I'm both a partner as well as editor-in-chief. These videos are a big part of my personal mission to help investors beat the market. So I hope you enjoy them and welcome any feedback in the comments section below. Let's get right into it with myth number 1. Higher yield equals better investment. As shared in the intro, too many folks are bedazzled by yields over 10%. These stocks are often a mirage. The high yield usually comes from a share price tumbling on bad earnings news. Too often, those deteriorating fundamentals will lead to a dividend cut and further share price losses. This is what we call a dividend trap, and for good reason. So let's not fall into the trap like investors in Lindell Basel Industries with the symbol of LYB. The nearly 10% dividend yield at the start of 2025, no doubt, ensnared many income-hungry investors. Yet 2 nasty earnings misses later, shares have fallen by over 40%. This more than wipes out the benefit of those quarterly dividend checks and clearly explains the risk in these high-yield dividend stocks. In many ways, the failure myth number 1 gives rise to this second myth, that being the allure of the dividend aristocrats. These aristocrats get their label by providing at least 25 consecutive years of dividend increases. These are some of the largest, most stable companies around like Procter & Gamble, Coca-Cola, 3M, and the like. The weakness of this approach is twofold. First is that the dividend yield is not that large, about 3% on average. That means for every $10,000 invested, you only get $300 in dividend income. And that is not going to pay the bills as you had intended when first going down this income stock route. Secondly, you are basically investing in the S&P 500. That's safe for sure, but no real possibility of outperforming the market. Now let's move on to myth number 3. Dividend stocks are always safe. This is relatively true when we're talking about those dividend aristocrats, those being the bluest of blue chip stocks. However, the more you seek higher yielding stocks, the more likely you're dealing with smaller, less financially sound companies. The kind of companies that are more likely to announce earnings misses, cut dividends, and endure a tumbling share price. The exact opposite of what we are trying to accomplish. Gladly, the solution to all 3 of these dividend myths is the same. We need to seek high yielding companies that are also fundamentally sound, meaning they are producing ample growth to both increase the dividend payments in the future and enjoy a rising share price, the sum total of which is what leads to consistent outperformance. Here is a list of the 10 key fundamental metrics you should look for. Note that these metrics are available on most free investing websites. First, we start off with revenue growth. Then roll on to earnings per share growth, free cash flow growth, rising gross margin, rising operating margin, return on invested capital, above 10% and rising is what we're looking for, and this is one of Warren Buffett's favorites. Return on equity above 15%. Then we're going to start looking debt to equity ratio below 1.0, current ratio above 1.5, and quick ratio above 1.0. Again, all 10 of these are readily available on most free investment websites, but it does take a little bit of work to do all that research stock by stock by stock. Gladly, I have an easier way. That solution is the Zen Ratings. Zen Ratings provides a 360-degree view of a stock's attractiveness, covering these key areas of value and growth and momentum, financial strength, safety, sentiment, and even exclusive AI factors. All in all, the Zen Ratings reviews 115 different factors for each stock, the most important of which for income investors are the 26 factors of financial strength and another 22 factors focused on growth. Not just earnings growth, but also growth of revenue, cash flow, profit margins, and EBITDA. Scoring well for financials and growth are the hallmarks of fundamentally sound companies, the types of companies more likely to beat earnings, raise dividends, and enjoy a rising share price. Here's the best news. You can get the Zen Ratings for free on over 4,600 stocks. That includes the growth and financial ratings we were talking about, plus the ratings for all the other key areas like value, safety, and sentiment, even our proprietary AI rating that finds stocks ready to outperform now. This is available to you 24/7 on our website at wallstreetzen.com. Please be sure to bookmark the site for future frequent visits. Now let me make it even easier for you. As promised in the intro, I want to share with you the top 7 income stocks to buy now. This strategy was built by the same data scientists who created the Zen Ratings model. In this case, they dialed into the factors that are most beneficial for income investing. The result is a strategy that narrows the field down to just the top 7 income stocks. And yes, that comes with impressive performance. In fact, the average return for the strategy is 24.96% per year. It goes all the way back to 2003. All in all, our income strategy has beaten the S&P 500 by nearly 3-1. And yes, it has beaten the market once again this year. These top 7 income stocks are just one proven portfolio inside one of our most popular services. I'm talking about the Zen strategies. Here's what you get with the Zen strategies. 11 strategies in total, each narrowed down to just the top 7 stocks each providing stellar performance, each updated daily. Truly, there is something for every investor in every market condition. This will become abundantly clear as you review this table showing off all 11 strategies and their consistent market-beating annual returns. AI factor, momentum, small caps, buy the dip, under 10, growth, income value, technology, large caps, even stocks to short. Yes, during a bear market, that is going to be your best friend. As you can see here, something for every investor in every market condition and outstanding, consistent returns going back to 2003. We invite you to explore all of our popular Zen strategies services right now, checking out all 11 strategies, investigating over 20 years of complete performance information, find the right strategies for you, then dial into those top 7 stocks for each. Just go to wallstreetzen.com/stock-strategies. If you found this video helpful, then please hit that like button down below. It tells YouTube to show this video to more investors who could use help with their investing approach. Also, be sure to subscribe to our channel so you don't miss out on any future stock picks and winning strategies. Last thing for today. Let me know what you thought about today's topic in the comments section below. I read every comment, and I'm generally interested in your thoughts. Perhaps even recommend topics for us to discuss in future videos. Thanks for joining me today, and here is wishing you a world of investing success.